everybody, my name is Brandy Phillips. I'm a real estate agent right here in Atlanta, Georgia. I'm gonna give you guys some time to come on as we, me and my lender, host our home buyer seminar. So come on in. Come on in. I'm going live from my business page.
That's cool. Yeah.
I'm about to share it to my personal.
I'm cool with it. I have no problem.
Okay. So as we come in, like I said, my name is Brandy Phillips. I'm a real estate agent. So if you're looking to buy a house, looking to sell a home, or if you just want to simply have a consultation so we can see where you are, where you currently stand, so we know we can fit and customize a game plan to get you to where you are looking for or to where you're going. So I'm in Atlanta. So of course, Atlanta's a big city. So the counties I service are Fulton County, DeKalb County, Gwinnett County, and Cobb County. I serve those areas specifically, but I could be anywhere. So let's go ahead and get started. So a lot of people reach out to me because I post a lot of stuff about home buying process, the benefits of home buying, and that type of thing. So I strongly recommend when you are ready to get started to reach out to a professional, preferably a real estate agent, because me personally, I have a database of lenders, credit repair specialists, I have inspectors, I have my own database that I rely on to help us get through this flow of the home buying process. So I recommend you reach out to a professional, someone who is educated, someone who is certified, someone who is licensed, someone who is knowledgeable to basically hold your hand as we take you from step A to step Z. So basically we'll set up an initial consultation just to see where you are, where you want to go, what you're looking for. And the next step is proof of funds. So that would be financials, like your bank statements, your W-2, forms if you work for an employer, if you are self-employed, that would be the 1099 forms, or you can have straight cash. So we'll talk about that a little bit later. So next would be proof of funds, so we can get you to the lender, so we can get you pre-qualified, so we can see where we are working with that. So the lender comes back to me with the pre-approval and how much you are pre-qualified for, and then that's when I help you start the home search process. So basically, we are going to look at what you are looking for. I don't know if you guys can see that, but what you are looking for in a home, if you want to be in a condo, if you want to be in a townhouse, or if you want to be in a rural area, maybe further out from the city, or if you want to be in a traditional single family home, or if you want to be in a new construction. This specific information will give me the guidelines of where we are going. Basically, it's just a map, so I can see where we're going and how we're going to get there. So we're going to see what you are looking for in a home, where do you want to live, and when we are looking to get you in the place you are looking for. So this is an in-depth consultation, so we can get a little bit deeper into the logistics of the home buying process. So I set up a home search, an automatic home search, multiple listing services, commonly known as the MLS. So I set up that. I go to open houses for you on your behalf, or you come with me so we can look at the houses that are tailored to what you're looking for, where you want to go, and when you're looking to move. And then the pre-approval is going to be the next step. So I have my lender right here, Mr. Nelson Thompson. He's a lender for over a decade of experience. So he's gonna help me out with this pre-approval process. Once we send over the proof of funds, this will the pre-approval come in. So go ahead and take it away.
Awesome, thank you. Hello everyone, again, my name is Nelson Thompson, AKA the Mortgage Sensei, and I've been in the business for, oh gosh, I'm gonna age myself, but I've been in the business for roughly about 13 years. And I've worked with big banks, I work with credit unions, I work with direct lenders, I work with brokers, and I have a really in-depth understanding of the home loan process and how I can quickly take you from where you are right now to where you want to be when it comes to buying a home. So I'm gonna turn this one right quick. I'm gonna turn it just a little bit. There we go. Now we match it all the way up. So what I want to do first is just kind of talk a little bit about the pre-approval process, right? Now, I wish my handwriting was as good as that. So please excuse my handwriting. I do numbers. I don't do writing or novels or anything like that. So the first thing I want to do, I want to separate the two terms, right? We have pre-qual versus pre-approvals, right? Now, there is a huge difference between these two, and understanding these two will better prepare you as a client when it comes to going out there and looking for a home. So first, let's talk about a pre-qual, right? A pre-qualification basically means that you get with a lender or a loan originator like myself, you do the application, get your credit pulled, you provide your financial documentations, and then that loan originator gives you a qualification letter. And there we go, right? Your loan is literally based off of that loan originator's ability to evaluate your credit, your income, your assets, the loan structuring, and put everything together, and that's it, right? Now, getting a pre-approval takes a little bit longer, right? But it is way better. The pre-approval is what we bring in what is called the underwriter, right? Now, for those that don't know who the underwriter is, this person by far is probably the most important person in the whole lending process. Personally, you know, any loan underwriters out there, underwriters are my favorite person, right? Because the underwriter is, I would hate to say gatekeeper, but in so many words, they are. They're going to be the ones that's going to evaluate your credit, your income, your assets, line it up with the program along with the home that you're looking to buy to ensure that you're meeting the program requirements of the loan. Now, the underwriter can do this up front before you even go under contract for the house. That way, you as a client, you'll know, okay, credit, income, assets, loan structuring wise, okay, I'm good to go. I just got to go find the right house, okay? Now, let's break down the pre-approval process because it's important to understand what's going to happen, or better yet, what should happen, because not all professionals are the same, which you can understand that. Just like in the NBA, right? You got rookies, you got veterans, you got all-stars, you got, legends, right? So you want to work with someone that is capable and competent and confident that can get you into a home. So let's break down the pre-approval process. Now, before I really talk about the process of the pre-approval, we need to talk about what makes up a home loan. Now, what I put here is the 5 pillars of a home loan, right? Now, all home loans, traditional loans, non-QM loans, they all go pretty much around the same major categories or the same major points. So the first point has to do with credit. I know it's an obvious one, right? But I talk about credit first because if you need to do something for credit with your credit report, that tends to take the longest to get done. So we're going to dive right into credit and get right to it. Now, a couple of things you need to know before I start breaking down credit and what I actually do to help my clients to get into a home. First, we're going to talk about programs, right? Just general programs, that way you get an understanding of what's going on with credit. Now, first we have, of course, what are called conventional loans. Conventional loans are like your Fannie Mae, your Freddie Mac loans, your cookie cutter type of loans, right? Conventional loans, minimum credit score starting out 620 credit score. And I'm going to talk about the difference in credit scores as well because it's important to understand. But conventional loans is 620. After that, you have your FHA loan. Now, your FHAs are pretty big when it comes to first-time home buyers. We see that a lot. Or people that need to stretch their qualification farther than a conventional loan. But FHA is that realm. Now, with FHA, technically, you can go down to a 550 credit score. I don't recommend it, but technically you can go down to a 550 credit score. Your sweet spot with FHA, however, will be a 580 or higher credit score. The reason why I'm saying that is if your credit score is between a 550 and a 579, so you're under 580, your down payment is at least 10% of the purchase price. But once you're a 580 or higher credit score, minimum down payment is 3.5% of the purchase price. So normally I tell people, hey, you're under a 580, you got to put 10% down. You got it? Okay, great. How about you take that extra 6.5% you got to put down, fix your credit, get it over 580, only put down 3.5% and get better terms on your loan. On top of that, we have VA loans. VA loans technically don't have a credit score, technically under the VA guidelines, but lenders don't play by the book all the time. So I would tell you minimum credit score with a VA loan is a 500 credit score. After that, we have USDA loans. USDA loans is basically for anyone that's looking to buy a home in a low populated area per square miles. That's basically the country, that's a rural area, so on and so forth. But for USDA loan, minimum 620 credit score or higher. We also have what is called non-QM products. Non-QM products is basically any other product that is not here. This can be your bank statement only loans. It can be your asset depletion loans, your 1099 only loans, your verification of employment only loans, so on and so forth. But basically it's programs that's available where you can't fit into these boxes here, right? Now, the downside with non-QM loan is always a higher down payment, right? Minimum down payment, 15% for high credit, 700 plus credit score. But you can have a lower credit, but the down payment could get up to 25, maybe 35% of the purchase price. Minimum qualifying credit score for these programs normally start right around a 640 credit score, but I recommend being at a 680 or higher credit score if you want to go down that route. That way you get some good lending terms. And then after that, of course, for anyone that's looking for a down payment assistance program, down payment assistance programs start at a 600 credit score. But again, that'll get you in the door, but I would recommend having something around a 660 credit score or higher. But you know, you can get in the door at a 600 and hopefully the terms work out where you can actually get into a home. Okay, so we talked about that. I just want to touch on that real quick, that way we get a good understanding. Now, when I talk about credit scores, right? Credit Karma is not your credit score. Just to be honest, Credit Karma is not your credit score. Your credit score has to be a mortgage version credit score. You have credit scores for different reasons, whether that's an auto loan, personal loan, credit card, you know, obviously mortgages, right? There's credit scores for different scoring models, to be technical, but there's different credit scores for different loan products or loan instruments. So, you know, if you do want to know what your actual mortgage credit score is without having your credit pulled by a lender where you could potentially get a hard inquiry, then I recommend going to a place like myfico.com or identityiq.com, and they have a section in either one of those that will tell you what your actual mortgage credit score is. Be sure to try to get all three credit bureaus, TransUnion, Equifax, Experian, and not just one, because we're going to look at all three of the credit scores. All right, now going back to the 5 pillars. So we have credit. Now, when I'm looking at credit, I put this into 2 categories, right? We have your score, and then we have your content, right? Now, score is pretty straightforward, right? We pull your credit, boom, your credit scores pop up. We look at your credit score, and then obviously we know what your credit score is. But when we're looking at your credit score, which you're going to have 3, so let's say one of them is a 702, and one is a 740, and one is a 723, right? Let's just say that's your credit scores. Well, when we're looking at it as a lender, we're going to say, okay, which score is in the middle? In this case, 723. And your whole loan is based off of 723, right? So if you are looking to work on your credit and you see your credit's going up here or whatever, keep in mind, whatever credit score is in the middle is what the lender is going to actually use, all right? Now, after the credit score, right, I go down my client's credit report and I'm going to look at everything. And I'm looking at the content, right? And when I'm looking at the content, or when a lender is looking at the content, we're looking at first payment history. Payment history, right? Now, payment history is helping the lender, aka the underwriter, but helping the lender determine, Do you actually pay your bills on time going forward right now before you take on a larger obligation, which is a mortgage, right? So my recommendation when it comes to payment history is pretty straightforward. Number one, I will tell you, the client, or tell my client to have at least 3 trade lines, right? This can be all credit cards, right? But you need at least 3 trade lines paying for at least 12 months. On-time payments, right? On-time payments. Now, can you get a home with less than 3 or no credit whatsoever? Short answer, yes, absolutely. But if you're looking for good or great lending terms, have at least 3 trade lines, making on-time payments for at least 12 months. Okay. Now, after that, we really don't care about how you use your credit cards, like your credit utilization or your credit usage. It affects your credit score when it comes to your credit cards, but the credit utilization does not affect us when it comes to the content of seeing whether you are able to repay the loan, right? We don't care about it in that capacity. We just want to make sure, are you making your minimum monthly payments over time? Now, as I'm going down, so I'm looking at payment history, we then going all the way down, I'm going to then look at your derogatory information, right? Your derogatory information, late payments, collections, charge-off, repossessions, child support reporting, any public records, bankruptcies, foreclosures, short sales. We're looking at all of that to determine, does that content fit within the qualifications of the loan program that you're looking to get? That's basically all we're looking to do. Now, when I'm scanning through the derogatory information and I'm looking at collections, right? Collections does not necessarily have to be paid off for you to get into a home. I've done loans for people that had a ton of collections and they got into a home. But what collections will do, 2 things. One, obviously, it'll affect your credit score. So if your credit score is too low, then maybe addressing collections or paying off your credit cards will work, right, to get your credit score up. Another area that collections will affect you is on payments. Now, technically, when it comes to collection, there's no obligated repayment. They're just trying to collect the full debt that you owe. But when it comes to lending, when we're looking at collections, let's say you have a total $2,000 or more in collections. So you got $500 here in collections, $1,200 here in collections, $800 here in collections, whatever, right? But altogether it's $2,000 or more. Then we have to do what is called a calculated payment. We take the full amount that's owed, multiply by 5. Now we calculated a monthly payment, and that could be a problem. So that could lead to you maybe having to pay off your collections. But again, get with a professional like myself to make sure you do what you have to do, not what you think you should, okay? So collections, charge-offs, right? Charge-offs and repos falls in the same category, which is we don't care about them. Long story short, we don't care about them. The only thing that charge-offs and repos actually do to you in this process is affect your credit score. And that's it. We don't care anything else beyond that when it comes to you getting into a home, right? So, and the same thing, I've done loans for a lot of people that had a car. Let's say it's a $42,300, it's somewhere around there, $42,300 charge off or repossession for auto loan. And they got credit cards to say that it's charged off, $12,000 credit card charged off. But their credit score was high enough to get the program. They got a home, right? So again, you don't necessarily have to do everything to your credit. Let's do enough to get you home ownership, continue to work on your credit, and then you can refinance at a later date, which I'll go into more detail a little bit later. All right. Now, these derogatories, collections, charge-off, repos, these are called, in my experience, minor derogs or minor derogatory accounts. Then you have what is called major derogatory accounts, right? And this would be like your bankruptcies, your foreclosures, right? You know, that's really what we're talking about. Now, depending on the loan program, will require X amount of time between the discharge of the bankruptcy or the start of your repayment plan if you got a Chapter 13 bankruptcy, or the time between a short sale or a foreclosure until when you can get into a home. Now, I'm just going to talk from a standpoint of, okay, Nelson, I got one of those. How quickly can I get in a home? Well, from a standpoint of bankruptcy, if it is like a Chapter 7, which means all your debt has been discharged, then we're looking at a minimum 2 years from your discharge date. If it's a Chapter 13, so a Chapter 13 means that you went to the bankruptcy court. There are debts that's going to go through the bankruptcy. You agree to a repayment plan with the courts. And from a Chapter 13, we need 12 months on-time payments made to the Chapter 13 bankruptcy and the bankruptcy judge to approve you to be able to go buy a home. And if that's a yes and yes, cool. Bankruptcy, not a problem. Foreclosure, I'll just tell you 4 years. Straightforward. 4 years since you broke your foreclosure, because that's pretty serious in the lending world. You're going to a lender to get a loan to buy a house, but on your credit, there's a home that you did have a loan on that was foreclosed on. So 4 years to wait. All right, unless you get it off your credit report. If you need a good credit repair specialist, let me know. Yes, you can get stuff like this off your credit report if they really know what they're doing. All right, so let's move all of this. Now that basically covers credit, okay? And yes, there's more to it, I know, for those credit specialists out there and the loan originators and the underwriters watching it like, Nelson, what about this and what about that and what about... Hey, this is a case-by-case scenario, so definitely get with a professional and we'll get more detailed according to your loan program. But right now, we're just talking about home buying seminar. All right, number 2. Now, number 2 is probably the most important part of the process. Number 1 takes the most time to get done. Maybe you got to send in dispute letters or whatever. That can take 30, 45, 60 plus days to get stuff fixed on your credit, especially if you got fraud alerts or identity theft or whatever the case may be, or some serious stuff that you're fighting and battling against. But when it comes to the second, this is the most important thing. When it comes to me getting my license as a mortgage loan originator, this is what they harp on all day long. And this is your ability to repay the loan, right? AKA your debt to income ratio, right? Can you afford this home? It's basically all we're trying to determine. Now, the way we do this is very simple. Number 1, we take your credit debts, okay? Now, what we care when it comes to credit debt is your minimum monthly payment, right? Or your calculated monthly payment. If you recall what I was talking about with the collections, how we got to calculate a monthly payment. We're talking about minimum monthly payments and calculated monthly payments according to the program, plus your court debts, right? Which you may or may not have any. But for those that do, alimony, child support, separate maintenance, judgments, any money owed to the IRS, any money owed to the federal, state, local government, right? Basically, someone took you to court, said you owe some money, judge says, I agree, and now you have to pay it, right? In some capacity. So court debts plus housing expense. Now, housing expense is for the home that you're looking to buy, right? And these are all based off of a monthly payment, right? And the house that you're looking to buy, principal, interest, taxes, insurance, mortgage insurance, and any association dues like condo dues or community dues or something like that, right? So we add all of this together and we divide that by, and I'm gonna use an underwriting term, we're gonna divide it by your qualifying effective income. This is why getting a pre-approval is so important, right? So what that means is that we're going to determine from your income whether you get paid hourly, salary, commissions, are you getting what I call performance-based income, overtime, bonuses, shift differentials, You know, are you self-employed, right? Are we using rent schedules or whatever case may be? How we're determining your income, we're going to calculate it according to the program, and how underwriters actually calculate is the way I do it. And we're going to figure out what your income is. And then we take your debts divided by income, and it's going to give us a percentage. And that percentage has to be within the loan qualification, right? Now, for those that's looking at this and say, oh man, Nelson, this is a whole lot of stuff. I don't even know. I'm scared. Oh, it's freaking me out. Don't worry about this, right? Again, a professional like myself is going to do all of the work for you and properly advise you to what you should do if you don't qualify now, right? That's what I do for the last 13 years. So from a standpoint of qualifying ratios, you'll hear a lot of stuff out there. Oh, you got to be under 40%. Oh, be under 50%. Oh, you can go up to this. Every program is different, right? Conventional loans, yeah, they cap out at 50%. FHA loans, they could go up to 57%. VA loans, they don't really have a DTI. It's credit sensitive. They only care about what is called your residual income, and that's for another class to talk about. USDA loans, they cap you at under 43%. You can't go higher than that with USDA loans. And most non-QM loans are at 50%. But again, we're going to figure this out for you to make sure you're looking at the right home that you can actually go out there and buy, because nothing's worse than finding a house, falling in love with it. You want to get it, but you don't make enough money to get it, right? So that's how we calculate repayment ability. Now, the third pillar in this has to do with funds available for closing, right? Long story short, where's the money coming from? Not the money you need to repay the loan, but the money you got to bring to the closing table so you can get the house, right? Now, it's broken down into 3 categories. The first category is down payment, right? Second category is your closing costs. I separate these two on purpose, and I'll explain to you in just a second. And third is your reserves. Reserves, right? I messed up there, but that's okay. So down payment, let's talk about that, right? Down payment is basically your minimum investment requirement. It's not a cost. People get that confused. It's not a cost. Down payment means you're taking your cash and you're converting it into the equity in the home that you're buying, right? So you still have the value, it's not cash. It's in the equity of your home. You get it back when you sell. You get it back maybe if the home appreciates, you refinance, but you're putting stock into the home that you're looking to buy. That's down payment. Closing costs goes to true third-party vendors, right? So this is your title company, your government recording, the appraisal, the credit report, the setup for your escrow account for property taxes and homeowners insurance, right? Any type of home warranties and so on and so forth. All that fits right here into closing costs, right? And then last is your reserves. So reserves is basically how much money you got left after you bring the down payment and closing costs to the closing table, right? And it's based off of the monthly payment for the mortgage. So let's say the mortgage payment is $3,200, right? That's your mortgage payment. How many times do you have $3,200 sitting into in your bank or in your retirement account or anything along those lines? How many times is it sitting there? And that is your reserves, okay? Now, let's talk about how to pay this. Because I know somebody possibly is like, man, Nelson, that sounds like a whole lot of money. I can buy no house. We see these home prices. I can come up with 3.5% or 20%, these $400,000, $500,000 houses. How you gonna do that, Nelson? No problem. I'm already there with you. So when we talk about down payment can only come from your side of the table, meaning that the seller can't help you, the professionals, can't help you. You can't get credit. Nobody can help you with that. Down payment is your requirement. However, down payment can come from you. It can come from a donor. A donor is like friends, family, relatives. Your employer might want to gift you the money, meaning they're giving you the money with no obligation of you repaying. Or you're getting a down payment assistance program in some capacity, right? So just because you don't have a down payment doesn't mean you can't get into a home. It just means we have to do what I like to term as creative financing to help you out. Now, closing costs can come from your side of the table or the seller side of the table. Now, same thing, you, donor, any type of closing cost assistance programs, which is basically down payment assistance, it's just now you're using it towards closing costs, or you got stuff extra left over, or you're getting what is called seller concessions. And I'll leave that to the realtor. I don't get into that too much, but basically the seller can give you X amount of dollars to help cover your closing costs. And then reserves is your money, right? You could get a gift from a donor and we could use it towards reserves, but again, that money's staying in your account and you're not giving it back. Now, after that, the fourth pillar has to do with the actual home that you're looking to buy, right? So we call that subject property, right? That's the fourth pillar. And there's only two things we really care about when it comes to the subject property, right? Number one is loan to value, and number two is the condition, right? And let's talk about that a little bit just before I go on. Loan to value, long story means, is the home worth what you're buying it for? So if you're buying a home that's $400,000, right? Is the home actually worth $400,000, or is it worth $375,000? Or in your favor, maybe it's worth $425,000, right? But what we need to determine is the home worth what you're actually buying it for? Now, in a situation where the home is worth more than what you're buying for, hey man, you're making out like a bandit. Good job. Good job, realtor. Good job, you picked the right house. If the home is worth less than what you're buying it for, then you have to pay this difference. So $375,000, $400,000, that is $25,000 plus the down payment for the down payment for the $375,000. You do the down payment based off of the value. So difference plus the down payment plus the closing costs plus the reserves if you need it. That's how it works. Okay. Again, I know this is a lot. Don't stress out. Don't freak out. You don't need to know how to do this stuff. That's what I'm here for. That's what we're here for, right? But you at least need to know what's going on and what the professional should be doing for you, okay? Now, number 5, last pillar, is the program. It's the program that you're going with. Is it conventional? Is it FHA? Is it USDA? What is it that you're going to get? And what we do, we take credit, repayment ability, funds, the property that you're getting them, and we line that up with the program, and the underwriter makes sure 1, 2, 3, 4 is within program requirements, right? Guidelines, overlays. Does 1, 2, 3, and 4 fit within the qualifications required for the underwriter to say, yes, go buy that home? That's how that works. Now that's the 5 pillars, okay? Now that we have a better understanding of just how a loan works in general, how does a lender look at it? What are their determining factors, right? Next, we're going to talk about the step-by-step process to get pre-approved. So first thing we're going to talk about, let's put pre-approval up here, right? And number 1 is loan application. Loan application, right? Now, with my clients, the first thing I do before the loan application, I do have a free consultation call with you. That way we can determine what your goals are. We can determine, you know, what you know about the process, right? 5 pillars why. Make sure you are prepared to really get this going, right? And if anything, I'm trying to prevent you wasting your time. After we have the conversation and make sure, you know, we're heading in the right direction, I then do a loan application. And I gotta put this as a star detail, right? Okay? An insider thing here is your home loan starts and ends with the application. The underwriter starts and ends with your application. So having a detailed and accurate application is imperative through the home loan process. Now, we're going to be asking you things like what's your full legal name, your date of birth, your social, your 2-year residential history, your 2-year employment history, or technically your last 2 calendar years. That's a technical term. But your 2-year history when it comes to employment history, we're getting your assets put on there, like your bank statement, account number, your balances, whatever. We're going to ask you some declaration, like are you a first-time home buyer? Have you owned a home before? Have you had any major derogatory event, bankruptcy, whatever? Are you involved in a lawsuit? We're asking declarations, we're asking government monitoring, and we're taking a detailed loan application. That way we understand what we should be looking at, what I should be gathering in order to get you ready to get through the home buying process. Number 2, I did do a credit order, right? Now the credit order, we can do a credit review, or we can do a straight hard check, right? Now, the easiest way to go about doing this is, again, you got access to your credit report. It may be Credit Karma, free service, MyFICO you're paying, Identity IQ you're paying, or any other vendor that you're using. But you have access to your credit report. If you don't, you can go to annual free credit report, or free, I can't remember, annualcreditreport.com, something like that. You can Google it. But you can go and find annualcreditreport.com and get your credit report for free, right? Just answer some questions, put in your information, and then you got to do it 3 times, 1 for each bureau. Download the credit report. You can contact me. We'll review your credit. It won't tell us your credit score, but looking at the credit content, I have a clear idea of where you at roughly when it comes to your credit score. But we do a credit order, and then we go through the process. I look at your credit score, I look at your content. We have a conversation about your credit report. And if we need to pause and make some changes, I will give my clients a detailed credit plan that is specific to them, that is going to be effective and efficient at the same time. But we do a credit order. Number 3, we gather your financial documents, right? So your financial documents will be, your income documents, pay stubs, W-2s, maybe we need your tax returns, maybe we need 1099s, whatever the case may be. Again, everybody's different when it comes to documentation that could be needed. We also will gather your asset documents. So this will be your last 2 months worth of bank statements, your most recent retirement account, anything along those lines. Maybe you are getting gift funds. We'll go ahead and get donor letters, get proof of funds when it comes to your donor. But we're getting your financial documents. We might get letter of explanations. The list goes on and on. Again, it's a case-by-case scenario, right? I can give you a full list, but the full list a lot of that stuff may not even apply to you. But we gather your financial documents, right? So, application, credit order, financial documents. The next thing I do for my clients, I then do what is called an initial loan structure, right? So in this area, what I'm doing, I'm taking a bird's eye view of your financial situation. And then I'm going to look for the path of least resistance. What program can I get you in that can get you into the home as painless and as seamless as possible, right? Now, we'll structure the loan. Again, I'm looking at DTI, right? And I'm trying to determine what is your max amount that I can get you without going super crazy trying to overstretch the loan or whatnot, right? And then from there, once I've determined what your max amount is, and I have your loan initially structured, I then contact my client and we'll go over the loan terms. We'll talk about the payment, we'll talk about the rates, we'll talk about the out-of-pocket expense, we'll talk about the game plan of execution. Maybe we have to go get concessions, or you have to go get a donor, or you have to go do a home buying education under HUD in order to get this down payment assistance program. Whatever it is, I have the conversation with you. And once you say, okay, Nelson, this is good, this is in alignment, this is going to get me to where I need to be as a home buyer, I then take this initial loan structuring and I submit it to the underwriter. Before you even go and look at the house, I submit it to the underwriter. And I have the underwriter come in and look at your credit, your income, your assets, the way we structured the loan and the program, and they're going to look at everything. And they're going to issue a conditional loan approval, aka a pre-approval. And once we have that pre-approval from the underwriter, I then look at the conditions and I say, okay, of this condition list, how much of this stuff can we clear right now? And we clear everything we can. Some of that stuff we just won't, like the contract, the insurance order. We can't get the insurance until we know what house we want to buy. You haven't found a house yet. Title docs, same thing. Appraisal, same thing, right? There's going to be certain things that we just can't get. But anything that we can, we get it now. Because that's going to shorten the amount of time it takes for us to close, which could be the difference in you getting the home or not with the lender or with your seller. Seller will say, oh, I'll take this offer because you can get it done in 14 days because we did all of the hard work up front, versus this person over here who did not do any of the work and they need 45, maybe 60 days to close. See what I'm saying? So the pre-approval process is extremely important. So we submit it to the underwriter. Underwriter sends the information back. We clear whatever conditions that we need to clear. I issue out the pre-approval letter. And then at that point in time, I give the pre-approval letter to you. I give the pre-approval letter to your realtor. And then I work with your realtor that you select in order to work as a team to help you get into a home. And then at that point in time, the realtor takes over, which is where Brittany takes over. Oh, Brandy, I did that, didn't I? Oh, I'm so sorry, I did that.
It's okay. My name is Brandy, but they should know that already. So that's basically an extensive overview of the pre-approval process. So I'm so glad Nelson dropped some gems on what to look for, what you need to bring to the table up front. So we can go ahead and get you the home that you're looking for. So next will be, after we do the home search criteria, like I mentioned earlier, we'll go to open houses. We do automatic search for specifically notating the things you're looking for in the home. Let's say we found the home that you're looking for. That's when the offer process starts. So basically here is just myself being your buyer's agent and the sales agent going back and forth on how we can get both parties the best deal for this home. So to make your offer competitive, the earnest money deposit is normally 1% of the purchase price, but to make it competitive, it can be between 1% to 3%. You can even bring in a larger down payment amount. Most down payments amounts between $10,000 to $15,000. Of course, there's down payment assistance to help with that, but if you bring something even larger, like $20,000 down payment, that can help make your offer more competitive and have the seller more interested in selling the home to you. And that's pretty much it. So that the negotiation process starts. So basically, I'll be in contact with you as we go along the process, and then offer and acceptance. We'll get that acceptance message, and then we'll go ahead and get rocking and rolling from there. And then next is going to be the third-party services that more than likely the lender needs to close the loan, and that would be like appraisers, that would be like the title companies, that would be home inspectors, those third-party companies who will have to review the home internally and externally to make sure the home is compliant with federal regulations. And then let's see what's going to be next after that.
After the offer process and the acceptance, and you give the earnest money deposit, you then start the formal process when it comes to closing and underwriting. So, basically, Brandy helps you find the home. Oh, yep, I did it right. I had to stop for a minute. I was like, wait. She helps you find a home. Fantastic at that. I'll leave that all in her hands. You find a home, offer, accept, earnest money. Now, Brandy will send to me the contract and a copy of the earnest money, and then I hop back in and we start the whole nother process that I'm going to talk about. So this next process has to do with underwriting and processing, basically. So once I receive the contract and the earnest money, but really just a contract, an executed contract, meaning that you signed, the buyer, the seller signed, the agents, both agents have signed, right? And now we're rocking and rolling. So I get your contract in, and the first thing I got to get you, the client, I have to get out your initial loan disclosures, right? Your initial loan disclosures, right? Now it's going to be a big package. It's going to be thick, right? It's going to be all electronic. We're not going to, well, we could, but normally we don't mail it. You don't have to print anything out. Think DocuSign, but you're going to get documents sent to you electronically for you to sign. while you're signing those documents, most people just click, 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 and move on with their life. I'm telling you right now, there's 2 disclosures that you want to stop and pay attention to. The first is your loan application. Again, the loan starts and ends with the application. So you're going to pull up the application, you're going to look at it, and you're going to make sure everything on there is correct. Everything is accurate. After that, you're going to look at what is called your initial loan estimate. Now, your initial loan estimate keyword is estimate. We're going to overestimate what your costs are. Maybe we haven't gotten back your title docs. Maybe we haven't gotten your insurance in or gotten the appraisal cost confirmed or something along those lines. We haven't actually done that yet, right? Well, the loan estimate is going to come out. Mine are normally overinflated. That way the numbers come down the closer we get to closing. And normally my loan estimates are the exact same numbers that I go over with during the pre-approval process. So you review both of these. You let your loan originator know, hey, Nelson, this needs to be changed. You missed this letter. Or here's a good one. My name is Brandy, not Brittany. Nelson, you messed up, right? Hey, we all make mistakes, but we'll make those changes. We get things fixed right up front, okay? Now, after the initial disclosures are out, you have to sign those, of course, and there's something important called the ITP, right? Intent to proceed. Until you sign the intent to proceed, I'm handcuffed. There's nothing we can do as a lender. You haven't given us the authority or the right or the ability to go work on your behalf. So you're going to sign those as quickly as possible. You're going to review the loan application, review the loan estimate, sign all the disclosures so the intent to proceed is signed so I can actually help you and get you into this home, okay, legally. After that, there it is. After that, thank you. So you got the initial loan disclosures done. After that, I'm looking to order your third-party services. As Brandy said, I am personally ordering those for you, right? Or my team is, you know. But we're going to order your title docs. We're going to order your homeowner's insurance policy, right? We're going to order the appraisal for you, right? These are the standard stuff that's automatic, right? We're going to order all of that for you on your behalf. And we're going to request from you updated documents, right? So let's say the time between when you was pre-approved, meaning the underwriter looked at it before you started looking in the house, to the time that you actually go on the contract. Let's say you've gotten new pay stubs, you've gotten new bank statements or whatever. We got to get everything current on the file according to when the contract was executed. So you'll provide all of that. Once I have this, the ITP, signed and updated documents for you, we resubmit it back to the underwriter with the contract. And the underwriter goes in and then, you know, make sure everything's adjusted and updated according to the contract and whatnot, and then the ITP is signed the whole 9 yards, and they're going to reissue a conditional loan approval, which should be exactly the same, or it may say, hey, give me an updated this or update that or whatever the case may be. Now, from there, after the underwriter has did the formal initial review of your documents, so initial disclosures, you sign, and we order the third-party services. The underwriter is going to issue what's called, I call it a CLA, but it's called basically a conditional loan approval, meaning that, okay, we're going to approve your loan provided that these conditions are met, okay? Now, you may or may not see it. In most cases, you'll never see this conditional loan approval, but you may see it. It depends on the professional that you're working with. But there's 3 things that happens here, or 3 categories with the conditional loan approval. You have what is called PTAs, you have PTDs, and you have PTFs, right? That's what's on the conditional loan approval. Now, if you went through the pre-approval process with a loan originator or a professional, whatever, you see me doing quotes here, right? And you go on the contract and the whole 9 yards, and you submit the file to the underwriter, and that puppy come back with PTAs, more likely that loan originator did a horrible job. Straightforward. Because what PTA means, prior to approval, meaning that the underwriter has looked at the file and says, oh man, credit, income, right? The loan structuring, right? The assets or the funds, it ain't there. It ain't there. We don't have a loan, and the underwriter will suspend your file, meaning they will just put a hard stop on your file until the loan is restructured where you actually do qualify. Now, working with me, we don't have this problem. But if something comes up like that, I'm telling you right now, that's what happened. And the loan originator is just not being honest with you. All right, after that, you have what is called prior to docs. Prior to docs is meaning, okay, you are approved, we'll do the loan, but you got to clear these conditions. It could be getting the title docs back, get the insurance policy back, get the appraisal report back, get this letter signed. It can be whatever, sign these disclosures, whatever it is, lock the rate, which I'm gonna cover in just a second. But get your prior to docs back. Once you clear all those conditions and you are now able to release docs, you are now cleared to close. But you still have PTFs, which is prior to funds. And I'll cover that a little bit later as well. Okay, so you got your PTAs, PTDs, PTFs. You understand that. Again, you don't have to do any of this work besides providing the documents or whatever. But again, you need to know what's going on. Okay, so we're going through the process. We've had the file initially underwriting. We got the conditional loan approval. We're clearing the conditions in order to get cleared to close. And we're waiting on the third-party orders to come back. So we're waiting on the title to send us the title docs back accurately with all the names and whatever according to the total loan amount. We're waiting on the appraisal report to come back. We're waiting on all this stuff to come back. Once it comes in and we clear all the required conditions and you get cleared to close, you're going to closing, right? But you're not going to closing at this right moment. Because here's what happened that a lot of people don't understand and sometimes shoot themselves in the foot. Once you're cleared to close, right, there is one last step that has to happen before you can sign. And what happens is the underwriter issues the clear to close. And then the underwriter steps out of the frame. And then who steps in the frame is the closer / funder. Now, depending on the lender, most lenders wait until you receive the clear to close before the closer or the funder even enters the picture. Some allow them to come in early, but a lot of them just don't. Now, what the closer and funder does is communicate between the lender. So they're representing the lender, right? They communicate directly to, in the state of Georgia, the closing attorney office, AKA the title company. And there's 3 things that has to happen before you can sign and actually own that home. And the first thing they're going to do is balancing, right? And when you go through the home loan process, you may hear your realtor say this or whatever, the title company might say it to you or whatever case may be. But basically what's happening is there is a form that's called your loan disclosure, right? Now, of course, I did skip one step here. You got to make sure you get your interest rate locked in, right? Because you can't get clear to close until the rate's locked in. So you always know, you want to know if your rate is locked in or not, meaning that, in this case, rates are up there. So we just say you're getting a 7.75%, right? Is their rate and pricing actually locked in and your loan is secured according to that rate and hedging or not? Are you floating or are you locked? Okay, that's it when it comes to rate lock. All right, so back to balancing. So you have what is called a closing disclosure, right? And this closing disclosure have boxes and line items, right? It doesn't look like this exactly, but it has boxes and line items. And this is with the lender, right? And then the lender is going to communicate to the closing attorney. I'm gonna put CA to make it easy for me. They're gonna communicate to the closing attorney to make sure that each box and line item is exactly the same between the lender and the closing attorney down to the penny. And all money used towards this loan is accounted for. They're gonna make sure everything, and this can take a couple hours. It can take a couple days depending on how busy the lender is or how busy the closing attorney is or how difficult the file is, right? But there is a gap that happens between clear to close and actual closing is what I'm really trying to say. And it can be up to 48 to 72 hours, right? So you want to make sure you plan accordingly, meaning that if you are meant to close on the 30th, You can't close on the weekends, Saturdays and Sundays. Take that out. Give yourself 48 to 72 hours to make sure you're prepared to show up to closing. Or this is what the lender or the originator should be doing. All right, so that's one thing we got to do, balancing. The second thing we got to do is what's called doc release, right? Now, this doesn't take too long, but it could take a couple hours, right? It should be a couple minutes, but it could take a couple hours depending on what system and method that the lender is using, right? But ultimately, what's happening is closer funder, AKA the lender, communication with the closing attorney, boxes, line items are balanced down to the penny. Closing attorney confers to the lender confirms to the closing attorney. Lender then sends the loan package, right? The final docs. There's a lot of names that's used, but basically it's the lender docs you need to close to actually own the home. They release it. Why? Because all the numbers are actually matching now. And then the third thing that has to happen is what's called a wire release. Or just send the wire in this case. We just send the wire. Now, what that means is that you're buying a $400,000 house, right? In order to close, you got to bring $400,000 to the closing table. Which means what? The lender has to send $400,000. And there's nobody that gets in a car or mails or anything like that and bring a $400,000 check. We do a wire. But since it's such a large amount, we got to do a central bank wire, right? It's not like a transfer like you do, between your accounts or whatever, or family, with smaller amounts. It's a large sum of money that we have to ship from one side to the other side. And depending on who the central bank, or basically the banking system that, or the regional bank in which the lender established their account to do business in, will dictate the time, or what we like to call the cutoff time for the wire. It could be 12 o'clock, it could be 3 o'clock, it could be 5 o'clock. We don't know, right? It depends on the lender. But we got to get that wire out before cutoff so that the closing attorney actually has the money in the escrow account ready to go for closing. Again, get back 48 to 72 hours. That means the lender can do everything right, the closing attorney can do everything right, and the central bank is just taking forever, right? There's a lot of transactions happening that day. But again, this all has to occur before you can actually go to the closing table. Now, once all this happens, basically, I kind of sit back, step away, and let Brady take over.
Hey y'all, so you see how important it is to work with a team, an educated team, an experienced team, a team with integrity that's going to help you achieve the goals you're looking for. This is a lot. This is extensive, but that's why working with the right people will help you through this process seamlessly so we can make it as smooth and even quick as possible. So working with the right people can help you achieve whatever you're looking for. So after we go through the disclosures, we're preparing to go to the closing table. So it's literally a table. It's literally a table of the closing attorney is there. Myself as the real estate agent, as your buyer agent, I will be there. It's literally, it's called passing. So everybody's gonna sit around at the table and we're just gonna pass the papers along from person to person to person, and everyone's gonna sign on their respective fields where the signature is located, and then we're passing the title, we're passing the documentation, everything is taking place. This is like the moment that we've been waiting for, to see the smile on your face that we went through all this work. But I promise you, nothing worth having. It will come easy, but it's going to be so worth it in the end. And then, of course, once we pass those documents, once we pass the title, once we pass the paper showing the appraisal was done, showing inspection was done, going through all the paperwork, that's when the seller will pass the keys on to the buyer. And then once we get that completed, of course, there will be information to help you transition into a home buyer, like market updates, ways to refinance your home to get a better rate. Of course, everyone wants a better rate. And then homestead taxes, which is a tax benefit for homeowners. So there's benefits We just have to get you, we have to hold your hand, and we have to work together. This is a team effort. We have to work together. We have to communicate. We have to make sure we are all on the same page, literally, so we can get the job done for you in a timely fashion. And then this will be, you have anything else you want to add?
Yeah. You know, I know, right? I tend to go rock and roll. But there is some tips, right? We want to talk about tips. We want to talk about pitfalls, right? Because I see this all the time. It's normally always the same thing. All right, let me remove all of this, okay? Okay, so let's start with tips, right? Okay, again, these are just my professional opinion when it comes to the home loan process. So number one is a phrase I like to use. Marry the house, date the rate. Okay, so here's what that term actually means. The whole goal of this whole seminar is home ownership. Home ownership, right? So the goal here is we could say bare minimums, honestly, right? But you want to get into a home as quickly as possible, right? Now, the rate, you may or may not like the rate, but you can afford the home that you want or need for you and your family. And let's say it's equal or it's affordable compared to what you're paying in rent, right? So I always tell people, the ultimate goal is get the house, get into the home, own the home. Because the moment you own the home, number one, you instantly start to get the appreciation of the home, meaning that over time, the value goes up, right? So you immediately get that. Number two, in that calendar year, you get tax benefits. And for those that never own a home, you're going to love these tax benefits. You're going to see a bigger refund check. So you want to go ahead and try to own that home as quickly as possible. Now, as you own that home, you always want to try to improve your finances, your credit, try to make more money. I mean, we see what it is. Inflation is up. We see how these home prices go up. But ultimately, continue to improve your credit. And what you'll see is the market doing this, right? It goes up, it goes down, but over time, it's going up. Over time, it's going up. And let's say, right, worst case scenario, we always want to talk worst case, right? Worst case scenario, you bought your home here, and the market got down here. And you're like, oh, Nelson, you told me to get into a house, and then as soon as I got into this $400,000 house, the next year the market crashed, and I lost $100,000 worth of equity, and you lied to me. No, I didn't, because there's ebbs and flows in the market. For those that was around, I don't know people's ages or anything like that, but 2008 market crash. People had bought homes in 2007, and they lost 50% equity, whatever, right? They lost a ton of equity, right? But they maintained that home, and that same home, even though they initially lost all that equity came back at a later date. But they secured a price on the home, and the value increased over time. So you went down, you lost the equity, but you gained that back and a whole lot more, right? Home ownership is the key. Let's see, what's another thing, another tip? So when you're going through the process, I'll talk about credit, right? I hear a lot of people talk about credit. Oh, Nelson, I need to get my credit score higher. Oh, this, and that. I'm gonna tell you straightforward, right? Get your credit to the point where you can get a house. Get your credit to the point where you can get a house, because you can always improve your credit later. And 9 out of 10 times, you're going to refinance your mortgage anyway. Oh, no, I won't, Nelson. No, I won't. Yes, you will. I'm going to tell you why. You get a rate today at a 7.75%, right? Let's say 2, 3 years, maybe 5 years, whatever. Who knows? Federal Reserve controls all of that. Rates go back down under, let's say rates are X. They are under 5%, right? You're refinancing, but you said you'll never refinance. You absolutely would refinance, or you should, if the rates come down. So in that time, you're working on your credit. Let's say your credit is a 580. and you bought the house, and you continue to be due diligent and work on your credit. And now, you get your credit up to, let's call it a 640, right? And you make 6 payments on time, right? When you're trying to make that 7th payment, I get back with my clients. Had your credit improved? Yeah. Well, let's look at refinance options. Let's see if we can drop that rate and save you some money on your payment. But you already own the house. You got the tax benefits, you're getting the appreciation. Now we're just trying to improve upon your financial situation. So get into the house. Let's see, number 3. Did I do my multiplier? My 3 to 5? My 3 to 4 multiplier?
No, I don't think you did that in this session.
I don't think I did that. Number 3, right? Ballpark for the purchase price, right? So let's say you like, okay, Nelson, for whatever reason you decide, well, Nelson, before I start talking to you or talking to a lender, I don't know, right? I don't know, right? So here's how you can determine. Now you gotta be careful with this. A couple of disclaimers. Number 1, self-employed people, you can't do this equation, right? Unless you got your qualified effective income so you can actually know up front. But let's say you're hourly, your salary, you get commissions, but it's been consistent over the last 2 years, right? Here's what you can do. Take what your annual income is. Now, if you're using overtime and bonuses or whatever in that equation, make sure you've been receiving that overtime, bonuses, shift, differential, whatever for the last 2 years. If you have been, take what the annual income is, and then you're gonna multiply it by 3 and 4. Now, this is not a guideline. This is not public. This is just my personal professional opinion over the course of doing time, right? And you take your income and you multiply it by 3 or 4. So let's say you make $100,000, right? And you multiply that by 3 and 4. So you got 300,000, 400,000, and that's the range in which you can potentially buy. Now, can you buy less house? Obviously, yeah, you can buy less house. Can you buy more house? Yes, you could, right? We're talking about creative financing at that point. You gotta have the right experienced person that can come in and know how to, I hate to use this word, but we're gonna use it in a positive manner, manipulate the numbers in your favor so you can qualify for more house, right? You're gonna always put down more down payment. Maybe you qualify for a better program, you get your rate up, they allow you to use more of your income to qualify, so on and so forth. But this is a quick ballpark way to figure out your ballpark range of purchase price. Because nothing's worse than getting your hopes up, going out there looking for a home, and you find a home, and that home is $600,000, but all you can afford is $400,000. That deflates and that kills hope in an instant. So you want to make sure you're in the ballpark, and the fastest, easiest way, in my experience, is to do it this way. Now, if rates are higher or rates are lower, obviously this number will shift left or right, the range. But that's a good telltale sign to do there. So that's another tip for you. The 4th tip, right? I know we talked about it, but get with professional early. And I'm gonna put, I can't emphasize that enough. You want to get with a professional early. In my career, I've gotten with clients 2-3 years early before they were even able to buy, and got them a credit plan specific to their financial situation and a financial plan. Remember credit, what we need to do with credit score, credit content, and then financial plan, DTI, right? Remember the ballpark, whatever, that I just talked about. And getting this from the horse's mouth will allow you to make sure you're taking the most effective steps that's going to reduce the amount of time it's going to take you to get into a home. Or, maybe it helps you reorganize what you need to do. So let me give you this one example. This one client, I will never forget her, right? She was phenomenal in this case. So I was talking with this client, and she wanted to buy a house, and for privacy reasons, I can't say her name and get too detailed. But she wanted to buy a house, and she didn't qualify for the amount of house that she wanted to buy. And I'm talking to her, I'm trying to help her out or whatever. And, you know, we're trying to stretch it and do all the creative financing, and we just couldn't get there because it just wasn't enough income for her to repay the loan. So I had a heart-to-heart with her. I was like, hey, ma'am, can I be brutally honest with you? She's like, yeah, sure. I was like, you got to make more money, right? And I'm not saying that from my standpoint, but I'm saying that for the bank, because that's what the bank is saying in closed doors, right? You know, legally, they can't tell you to your face, man, you got to go out there and make some more money, man. You can't buy this house. They're not going to tell you that to your face. They're going to go say it in the back, and they're just going to give you a denial letter and send you about your merry way, and you go and you know, you got the Michael Jordan crying faces, whatever. I don't know what to do, right? But so I was honest with this lady. You need to go make some more money. Maybe it's time for a career change. That's all I said to her. Maybe it's time for a career change. So she took me up on the offer, surprisingly, or whatever. And this is how it went. So she gave me her bank statement. Before I told her bank statement, she had like less than a couple grand or whatever in the bank. You know, like $5,000, less than $5,000 in the bank. And we had the conversation. I told her, and this was like late summer, like around July, something like that. And she was like, okay, Nelson, I'm going to go make this happen. All right, cool. I believe it, right? She reached back out to me February, so the next year in February. And it was funny how she came to me. She was like, all right, Nelson, I think I'm ready. She had this little smirk grin on her face. I was like, all right, cool. Let's see what we can do. And she gives me her bank statements. This lady had $200,000 in the house, in her account, cash in her account. And I was like, oh, goodness. Oh, man, we got some legal stuff. What'd you do, man? You. She's like, no. I got involved with taxes. And I made $200,000 in taxes. Now, she just started a new career, so technically she didn't have a history of actually working that job, so I couldn't use that income in that capacity. But I was able to leverage the amount of money that she had to get her into a property. I had another client, she just changed careers. She was able to find a new employer, and she was with them for at least 6 months in this new field, and she made, you know, significantly more income. So the answer may be, it's time to go find some, you know, a new career. Maybe you need a co-signer, maybe something along those lines, right? But there was no way for her to know that if she didn't get with a professional early, so that I could have the hard conversation with her that the banks and the owners or whatever won't have with you. You know, I'm just going to shoot it and keep it to you real. And then she was able to get into a home. Now, I know I'm saying big numbers, but I am in a belief that everybody deserves a home. Now, the market may not believe that, but I believe everybody deserves a home, right? You might have to do something creatively. You might have to look in different areas. But, you know, we can go with lower loan amounts. We can go with higher loan amounts. But just know at the end of the day that there is a lot of programs that's available to help you get into a home. So those are tips. You got any tips too? Let me snatch mine away. No tips?
Look, you came in like a thief in the night and just swooped up, dropped some gems, dropped some bombs. You did what needed to be done.
Pitfalls.
Pitfalls.
Yeah, I'm gonna shut up.
On the home buying process?
Pitfalls. I'm gonna shut up.
That's important. So things to avoid?
Things to avoid. All right, so when you're going through the process, I can sum it up in one word, right? Maintain financial responsibility. I can't stress that aspect enough. So while you're going through the process, you got your credit. You don't want your credit to go down, right? And you especially don't want to add stuff new to your credit. So here's what I mean. This is a real life example. So I have this lady fairly recently. She was looking to buy a home. And you always buy the house before you go buy the car. Always buy the house before you buy the car. Because the car going to max you out. She had the potential to buy almost $350,000 worth of house. But she went and got an auto loan that was $800 a month. And now her qualifying ratio dropped well below $200,000, and now she's upset because she couldn't buy the house. But I understand if you need a car, you gotta get to work first. But get the house before you get the car, right? That's number one. Number two, rate lock, right? Rate lock. Know if your rate is locked or not, and when does the rate expire?
Okay.
When does it expire? Because if you don't close before your rate expires, what happens is that when you have to either extend or relock the rate. If you extend the rate, that means the pricing on the rate or how much it costs to get the rate. Either you're getting a credit or you're paying discount points. But whenever you have to extend the rate, you increase the cost on that rate, which can increase your closing costs. If your rate blows, or you blow the lock is what we call it, meaning you go past the expiration date of the rate, but you don't extend the rate, you have to relock the rate, and all lenders relock the rate, worst case pricing, plus a fee. So know if your rate is locked and when is the expiration date of that rate. I've seen situations, keyword, situations, well, I'll say this, earlier in my career when I was a rookie, I ain't know nothing. That's a better way of saying that. Going through the process, when I was year 1, 2, real early, right? I didn't lock the rate, right? I didn't lock the rate. And while we're going through the process, rates went up on me, right? So when it was time to lock the rate, because we were in a rising rate environment, this rate that I quoted them down here wasn't the same rate that was available when I was locking the rate. So know if your rate is locked. Now, you have to be in a position to lock the rate. Some lenders will allow you to lock the rate before you go under contract, which may or may not be beneficial. In most cases, is not, unless you're in a high rate and raising environment, which we just got out of with the Federal Reserve. But understand, the more days that you lock the term of the rate, the more it costs in money, which can increase your closing costs. So if you're in a declining market, meaning rates are coming down, you want to float that baby down to the last minute and lock in the rate. If you're in a rising rate environment, depending on how inclined the increase in the rate, you want to lock it in early with as much date time that's necessary. Okay, so that's two things. Let's see, what's another pitfall? DTI. So we talked about new debt. Let's talk about income, right? So once you actually lock the rate, right? Once we calculate your income, right? What you don't want to do is say, oh, I have this pre-approval. It's a blank check. I got this. Well, I'm going to quit. I'm going to go start a new company. Don't do that, because what people don't realize is that all loans, unless you're self-employed, but if you work for an employer, we have to get a verbal verification of employment. So not a written one, a verbal verification of employment, and that has to be within 10 days of us actually closing. So if I pre-approved you a month or 2 months ago, and you changed employers, and I had a customer that did this, and don't tell me, best believe,
it's gonna come back. It's
gonna come back. It's gonna bite you in the butt. So maintain financial worthiness, maintain credit. Don't add anything new. Don't get no new hard inquiries. I've had I had a client, I got pre-approved, and she went to the car dealership. They got her, right? Ran her credit. You know how car dealerships are. Ran her credit infinite amount of times. Credit score dropped. Loan terms changed. We was able to get in the house, but that rate went up, and she didn't like it. But she got a home, and we refinanced it later, and then she was happy. So credit, rate lock, income. Another
pitfall is not working with professional early, because people want to do it wing it themselves.
Professional, right?
But it's just like, let me help you. Let me set you up for success.
You're absolutely right. Getting the professional involved as early as you possibly can, will help you. Yeah, and then there's no point in bringing me early, and if you ain't gonna do anything I tell you to do. But the professional, and make sure they're competent, they're experienced, they have some knowledge, or at least they have a good team around them that's going to look out for you and make sure you get the deal done with as less stress and things going wrong. Because let's think about it. You're trying to buy a house, right? And what you don't want or need is any more stress on top of the fact that I gotta move my stuff from here over here, pay deposits for the here. I gotta transition, so I might have temporary living, but I want to move at the exact time that I don't have to be in this house no more, or you know, I'm relocating, whatever case may be. You want to work with a professional that's been down this road that can see well before it even happens. Hey, don't do that. Don't do that, because if you do, you may not get this house. So absolutely, professional. And then the last one I'll leave with, trust me, there's a whole lot more I can talk about.
Right, we could be here all day.
But here's the last one and I'm done. Be realistic. Be realistic, right? If that's all you can afford, that's all you can afford.
For now.
For now, exactly, for now. Maybe you have to make some changes, right? If you gotta, like some clients, you know, they don't want to change their income, that's fine, right? But you gotta look at the right house. You gotta be in the right market for what you qualify for, and that's it. And I'll give it back to you, and I'll let you close us out.
Okay, so thank you guys for joining me and Nelson as we gave you tips, some gems, some strategies, so we can get you into a home. Let's go ahead and start building that generational wealth that everyone, you know, we use that term a lot. So this is like a game plan. It's a lot of work, but not a lot of work. As long as you have the right people behind you, beside you, in front of you, to make sure that we are moving things along. Make sure we are going with the process. So I see some people in my live. Hey, Michelle. Hey,
Oh yeah.
T.
Do we got questions? We do
Hey,
Q&As.
Ramona. Hey, Nathaniel.
Any
Hey,
questions?
Keith. Do we have any questions before we close out? Anything that you want for us to reiterate? Do we have any questions? Thanks for joining our live today on this Saturday.
If you like it, let's see flames. Put flames in the comments.
I know that's right.
Is it good? Let's see flames. We got flames. Flame us up.
I didn't get my other phone.
Oh,
I didn't get my other phone.
I can't see. I'm not that good.
This bright ring light, it just blinded me. So, of course, you can reach out to me or him. In the meantime, if you have any questions, we can set up a consultation. My consultation are no cost. I just want to see where you are. I wanted to provide you some guidance, provide you some information, some knowledge, so we can help you, you know, 2 months from now, 3 months from now, 6 months from now, maybe a year from now. So once again, my name is Brandy Phillips. I'm a real estate agent right here in Atlanta, Georgia. So of course you can email me, or you can text me, call me, reach out to me. You can schedule an appointment on my calendar.
What's your number?
Here's my number. 67. So it's gonna be 678-570. Can y'all see that? 4984. So this is my personal cell phone number. So
What's that number again? I can't see it.
I know, right? It's gonna be 678-570-4984. So I'm a licensed real estate agent. I am brokered by eXp Realty, and there are international brokers. So that's a whole conversation for another time. That's a whole nother, you know, seminar for another time. But 678-570-4984. You can send me a text. I can shoot you my calendar so we can set up a meeting, set up a consultation, just so I can like gauge where you are, so I can put professionals like Nelson, you know, in the queue, so we can see what we need to do and where we need to go. Nelson, you have anything else you want to add?
No. Thank you everyone that joined in. You know, we'll be happy to see you on the other side of home ownership. And, you know, one last thing to leave you with. The only thing that separates you from the person that owns a home is that that person took action.
Okay, let's get it. Let's take action. Wait, it's fourth quarter now. So look, the weather's getting cooler. You know, the competition is less. And most people want to, you know, get into a home before the holidays or before the New Year. So reach out to me, reach out to Nelson, so we can help you. We're here to service you. So let's go ahead and get into this home ownership goal. So thank y'all so much for joining me on this beautiful Saturday, and inbox me, reach out. Have a good one.